Okay, good morning. We're ready to get started here, and I know we had our first exam last week, and so if anybody has any feedback or input on that you want to talk about, let me know. I'm more than glad to discuss that and find out what the issues are and whatnot. I don't think we had too many technical issues. Sometimes it does occur where people are having some difficulties with the exam program or the quiz programs within Wiley, and these are all within the Wiley system. So if you did, let me know. We'll try to deal with that. But otherwise, now we're going to sort of move into the sort of second segment of the class here. And what I've done is I pulled up the chapter 13 activities because we're going to start chapter 13 today. And I've deferred the due date on these till the 20th. And I think I have told the class on a number of occasions that I'm going to try to extend due dates as much as possible. The syllabus itself was sort of created by committee, and there's some gaps and some dead zones in there, frankly, that needed to kind of be filled in. So I would rather kind of fill it in with allowing you more time on homework, quiz, bonus type activities and discussions than just simply leaving it as a dead space. So anyway, that's so I've extended that till next Sunday. So what we're going to do, if you look on the syllabus, we just had our first exam. That was week 6. Our next exam is, I believe, week 11. I guess we could have pulled the syllabus up here, but and it's also going to cover 3 chapters. And so, and that's sort of a pre-planned theme of what we're doing here is about 3 chapters per exam. So we're going to pick up from where we left off and lead into the second set of materials that lead to the second exam. It begins with chapter 13. So homework, quiz, bonus, all due on the 20th, which is a week from this coming Sunday. Okay, so hopefully that will accommodate everyone, giving everyone enough time to do that. I mean, I really prefer to give people more time as opposed to less on these activities. I really think it benefits you to do that. So if you if you want to work ahead, that's perfectly fine. I know that we sometimes get student feedback on the course reviews where people say, well, we keep changing the due dates. And yeah, we did. We changed the due dates in your favor. And if you would like to do them earlier, feel free. That really is your option to do. So we don't want to make it to the point where we're not accommodating you to the extent possible. Okay, so any questions before we get going? We've got a couple people on the Zoom call. And one thing I wanted to talk about, and this is important, is the idea of, and let me try to pull this back over here. In Brightspace, there's an attendance link. And I mentioned this once, and I don't know that I'm really kind of emphasizing this enough here, but I want to point this out. This is under discussion. So if you go into coursework, click coursework and discussions. And I haven't posted one for this last week, but I will later today. There are a series of attendance links, and we're required to keep attendance for everybody who attends the class, whether they attend in person here at Montoya or on the live Zoom link, or just simply look at the video. And that's perfectly fine. That's why we designed the course to be accessible in 3 different ways. But we are required to capture attendance, and it doesn't look like too many people are posting to these. I would really like to kind of move these down further on the discussions link. And I put it under discussions because it's sort of an area that students are familiar with using, although I realize you can access the discussions via the course modules themselves. But all you have to do, and I gave you some a little bit of a script here, you can put whatever you like, just whatever day. And it's just a way to record your attendance. It's not for people who attend in person, and it's not for those who watch in the live Zoom link, but it is a way that we do record attendance. And if it were up to me, I wouldn't have that, but we are required to capture attendance. So unfortunately, that's kind of the situation. So please do that if you would. And I'll put one for week 6. I usually do it after the week has ended, once everyone's had a chance to do it, because I know a lot of people do work over the weekends. A lot of our students work and and whatnot. So I think it's a good idea to post those after the fact so that people have a chance to do that. So I'll post week 6, but I would really like to sort of move some of these down because we do have some further discussion activities coming up, and I don't want them sort of clogging that. And if anybody has a better idea as to how to record that, I'm all ears. But I know that we've done this traditionally in the attend anywhere sections. Okay. All right. So any questions? Let me look in the chat link here and see. I don't see there are any questions to begin with. So why don't we get started with the material for today? We're going to cover chapter 13. So we're covering chapter 13, which deals with something called CVP, cost volume profit. And it really is a piece that's, I think, very important to those who want to work in the accounting profession. I know not everyone who takes this course will work in accounting, and we realize that. We don't necessarily tailor it to be designed in that way. But I think that what is really important about cost volume profit is it sort of is an area of analysis that encompasses a lot of things. It's a broad topic in its own right. There are books that are written on the topic of CVP, but it really addresses the question of what good are accountants and what usefulness they can be in an organization to determine things like how much to produce, how little to produce. Do we stop producing this one thing? Do we shut down an entire business unit? These are all questions that sort of arise over this cost volume profit analysis. And I know that it's a lot of accountants that I've known over the years they spend a lot of time doing this. And in fact, there's a cottage industry of independent accountants who do this for businesses just to determine how profitable certain segments of their business are. So I had mentioned some time ago about managerial accounting that one of the purposes of it was to sort of address managerial effectiveness and how effective is management at getting to the core of the problem that is maximizing profit and eliminating those things which are not particularly profitable. I think that's really a key issue here. And I also said that from this standpoint, the role of accountants was to answer a bunch of what if questions. What if we do this? What if we do that? And many of them never become a thing at all. And in fact, we have a lot of exercises. If for those of you who will be accounting students going forward, we have a lot of exercises where we consider scenarios and back and forth discussions that never happen at all, but because we're trying to whittle down our choices. And so that's really what we're getting at with cost volume profit analysis. This is an important area. It also intersects a lot with microeconomics. And so I don't think too many people in this section yet have taken micro. If you have, that's good, because it really, there's a lot of overlap between here and micro in the sense that we deal with this idea of production and cost and how it leads to profitability. So in this chapter, and my plan was to spend a couple of weeks really talking about this. We've got the time to do it. And as I mentioned before, in the 15-week semester, we have a lot of time to cover all the material that we want to go through in a pace that I think is friendly to you all. I really do believe that. So we've got really 5 main objectives in this particular module. Modules are sort of our term for chapters. We're going to talk about different types of costs in terms of their behavior, variable, fixed, and a sort of hybrid of those we're going to call mixed. And we'll probably, hopefully today, look at the time here, we'll probably get to the high-low method of how we sort of suss out, how we pull out variable costs from the total mix of costs. And then we come back next on Wednesday, we'll talk about how this applies to income statements to determine something which is a new term called contribution margin. And we'll talk about why that's an important concept. And I'm going to make the case it's an important concept really across the business itself. I know that sometimes accounting professors and accounting personnel themselves sometimes lose track of the fact that we have to deal with a broader ecosystem in which accountants must operate. And contribution margin is one of those big pieces of the puzzle. So we're going to talk about that. We'll talk about break even. And break even is simply if we produce this much out and we make zero profit, then what is the point at which we need to produce in order to earn zero profit? Now, obviously, zero profit is not the goal. That's clearly not what organizations seek to do. Remember, when we say organizations, it's really a euphemism for for-profit entities, usually of the publicly traded variety. But the question is, how much do we need to get to break even? Because this is not an insignificant question. A lot of times when we're starting up a new product, we're not breaking even, we're losing money. And companies need to decide, okay, at what point do we get to break even? And how long is it going to take us? What's it going to cost us? Is it going to be a drag on overall earnings? Questions go on and on. And then the final one is the sales required to target some to achieve some targeted net income. So it's break even, which usually applies to a particular product or a line of business or a subsidiary or even a regional delineation. We're going to talk about all these sort of ways we can slice and dice companies. If break even is not the goal, maximizing profit is, but we are arriving at some sort of target net income that arrives really as a function of the budget process. And then what is our margin of safety that surrounds the idea of if we lose sales, how much sales can we lose before we drop down to break even? So these are interesting questions, and we don't have to discuss them today. And we're going to talk really about the first one and maybe two methods here. But I do want to spend some time talking about these. And there are plenty of resources out there on the internet if you want to sort of try to get some additional background. But I'm also available to answer questions if need be as well. So, all right, the first learning objectives variable is the issue of cost behavior. And we use the term cost behavior because we're really trying to figure out what do costs do. I really think this is an interesting sort of placement of this module coming right after job order costing, because even though job order costing is an important element of cost absorption and cost assignment to particular products, it's not always the norm because some business activities don't lend themselves well to it. But I think what's important about that particular segment of the class is it does sort of give us in the mode of thinking of, as we're moving production along, we're absorbing cost, we're absorbing cost, we're absorbing cost. And to this point, we've talked about costs as being direct costs or indirect costs. And we've talked about product costs versus period costs. And we're not going to really talk very much about period costs at all in this course, only toward the very end. Remember, period costs are those costs which do not attach themselves to products. But we are going to talk a lot about the behavior of costs here, some of which may be period, but a lot of which are product costs. And we're going to talk about the way that they behave, and we're going to talk about this really critical concept called the relevant range. So I know that this is one of my particular favorite segments of the class, and I don't say it just because I like the material. I do like the material, I'll confess, but I really think it's got lots and lots of relevance. It helps people understand what businesses are trying to do and why, and it really also explains why managers make the actions that they or take the steps that they do. So cost behavior analysis is the study of how costs respond to changes in the level of business activity. So, all right, so what are we talking about here? We're talking about the level of business activity really refers to the volume of whatever it is that we're doing. And by the way, they can apply to a job order costing methodology like what we just talked about in chapter 12. It can apply to process costing, which we just talked a little bit about as being sort of the opposite cost recovery or cost absorption method for mass-produced items. The key thing is we're talking about how these things vary or don't vary in response to the level of production. Because some costs change, others remain the same. And we'll identify those. We'll put names on these. We'll talk about these quite a lot. It also helps management to plan what's coming up. And this is really the budgeting process. And I've mentioned before that we're going to talk a bit more later in the course about budgeting and what it's all about. And it's really a planning technique. It's a tool that management uses to sort of lay out a roadmap. And all these terms kind of come to mind: roadmap, plan, strategic plan, budget. I mean, all these things are sort of interwoven together as management tries to decide, hey, what's going to happen? Management does not like to be blindsided by things that they can't foresee. Even things that they can't control, at least that they see them coming, they would prefer that as opposed to not see them coming. And so the budgeting process is going to be very important. But in terms of drilling down into the budget process, we're talking about really understanding the way that costs relate to changes in particular levels of volume. Because companies dial up and dial down their production of certain goods based upon really these considerations. How profitable are these products? and whatnot. And so it's not an insignificant business activity at all. And it applies to all businesses. And I can't think of any business that does not have either variable costs, which those are costs that do change, or fixed costs. I can't think of any that don't have a mixture of both. Just like I can't think of a business that doesn't have liabilities, even if it's a current liability. So these are things that are implicit really in the business environment. So it really applies to all kinds of businesses. And the starting point here is to talk about what it is that we're doing. That is measuring key business activities. It doesn't get too much more basic than that. So let's go to that. So let's get into cost behavior and talk about what's going on here. So when we talk about cost behavior, we are saying, okay, how do costs, and we've already talked about costs as being period costs, which are mostly administrative costs, and depreciation on the main headquarters, and employee benefits on the staff that works in IT and accounting and legal and all that. We've already talked about that. We've talked about period costs. We've talked about product costs. But what we're going to do is we're going to sort of back away a little bit from that, even though there's a definite emphasis on product costs, and talk about how costs actually behave in relation to activity. Because it seems like the layperson's kind of view on this would be, okay, well, if we produce more output, all of our costs are going to go up. If we produce less output, all of our costs are going to go down. But the problem is that's not the case. And so what we need to do, first of all, is determine this more versus less question and how we measure it. And so we're really talking about activity levels. And so we're talking about, in a retail company, we might be talking about sales dollars. It could get even finer than that. It could be sales dollars in particular stores. It could be sales dollars at particular times of the week, particular times of the year. These are all things that we sort of want to track. And it doesn't have to be dollars. In fact, it often is not dollars. Sometimes it is, but it's not always. Miles driven in a trucking company. How many miles are being driven? And the miles are a driver really for cost in itself. So trucking companies very much have a dependency on their wheels moving. And so how many miles being driven? Room occupancy in a hotel. I like this one. And by the way, I bring up this term RevPAR here, not because I want to sound smart or anything, but because there are all kinds of acronyms that are across all of different industries. It stands for revenue per available room. And it's just simply an idea that, okay, if we're tracking activity levels, then how much revenue per available room are we earning, are we generating across maybe all of our hotels? And so bigger hotel organizations like Marriott, Hilton, and whatnot, they'll capture this as sort of a bit of informational item that they want to know. It's the activity that we're trying to track, okay? And it could be revenue, it could be dollar figures, it doesn't have to be dollar figures, right? Also, restaurants might track things like revenue per available table. That's another metric. And they might track that based upon the weekday versus the a different time of the year and whatnot. Airlines track revenue based upon something called revenue per available seat mile. And revenue per available seat mile would be something like, okay, we've got all these seats available or not available, and so how much are we generating for those available seats? And that would be a particular measure. Also, in one area that may be of interest to those of you who may want to go into the restaurant business is something called day part measurements. And day parts are simply a way that restaurant chains break up the day based upon different buyer segments. As an example, McDonald's really used to have 3 day parts that would be breakfast, lunch, and dinner, and they would track revenue based upon the activity level in those particular areas. They did a great breakfast business and a pretty good lunch business, and for years had a really abysmal evening or dinner time business. And so to make up for that, then they started extending hours into the evening, particularly long late night drive-throughs. And I think we can all drive around Albuquerque and see the long lines at drive-throughs that extend over into late at night. And that's a day part in its own right. So it's just a way of segmenting activity. That's really what we're trying to get at. Remember, the whole issue is we're trying to track activity level that may go up and go down with costs that may go up and down. And that's the concept that we introduced back in chapter 12 they're going to pick up on your dance classes taught by a dance studio. I guess that's one. That wouldn't have been one that I would have thought about, but okay. It's whatever the activity level that is sort of driving this. And also, we can get as complicated as we like with this, and I'd like to not get overly complicated. We can get into this idea of cyclical changes throughout the year, that the retail company gets busier in the fourth quarter of the year if they have a calendar year, fiscal year, for obvious reasons, Christmas shopping and whatnot. So we can divide these however we like and decide then how much we want to commit our resources to these particular segments of activity. And the term segment is used all the time in business. And then one thing I really like here is many companies use more than one measurement. And they can be expressed in unit terms, dollar terms, or whatever else makes some kind of sense. And there's quite a variety. And really, as I mentioned at the outset, that there really are all kinds of different discussions and analyses and cost behavior analysis. But really what we're trying to get at here is some of the basics. And so my getting into airlines and hotels is really sort of an effort at trying to emphasize the fact that we've got different forms of analysis out there, and it's a fairly rich set of analyses. Okay. Also, it's the study of how specific costs relate to how behavior reacts to changes in costs. And we have to select something, and this slide is a little bit redundant because we're talking about something called either a volume index or activity index. I think accountants prefer the term activity index because it sort of links itself to specific things which are measurable, observable, reliable, identifiable, whereas volume, is maybe a little bit more associated with either units or dollars. And we don't necessarily want to attach ourselves to only units or dollars. What we do want to find out is what is going on within the business that causes changes in the behavior of costs. This is a really important, really important question here. What is going on? What causes change in cost, and why? And maybe more importantly, what can we do about it, if anything? Can we manage costs? And I'm going to make my own personal case is that I think cost management is a difficult process. I know that managers for many, many years have tried to manage costs and try to bring them down and have done all these schemes to reduce costs. And I think with varying degrees of success, I might add. And I think the key thing that we should understand is that costs are a necessary part of doing business. Just as I can't think of a company that does not have liabilities or some kind of debt, even if it's very short-term debt. I cannot imagine any organization that does not incur cost. I just can't think of what it would be. It must be extremely small, and maybe they're not doing a very good job of recording it. So we have to understand the costs are there. Yes, we can manage it. It doesn't mean we have to minimize it. And I think this is a departure from what I think a lot of people may understand about management and managing costs, because I think the prevalent view in society is the idea that managers always want to cut costs to the very bone, reduce them to as little as possible, to pay workers as little as possible, to bargain in a very hard way on every type of purchase. But that's not really the case. I mean, I think there's not a lot of support for that. And in fact, I think the evidence is just the opposite, that a lot of very successful organizations are not trying to drive their costs to a minimum, but rather to try to get a handle on what costs are. And then if there are costs in certain areas that are not manageable or not commensurate with what the benefit is, then I think we try to deal with that. I think that's really the more important question. Okay. All right. Any questions so far about anything? Okay. Well, let's get into the heart of this particular segment. We've got different kinds of costs, and these numbers change based upon changes in activity level. And so again, we're going to use the term activity level. And we have variable costs, and we'll get to fixed costs here in a second. And then we'll get further down the road, we'll talk about mixed costs, which are sort of a hybrid of both of those. Variable costs are what they sound like they are. They change with the level of production, and usually they go directly, or what economists would say, a positive correlation between that and the change in the activity level. Meaning that if production goes up, variable costs go up. if production goes down, variable costs go down. They vary in the exact same direction. Whether or not those are proportional or not is subject to some debate, but we're going to take the view here, at least starting out, that in the short run, these costs are relatively commensurate with production. So the example given here is if activity level increases, whatever that activity level is, whether it's this dance lessons or tennis lessons or dental visits or whatever, if they go up by 10%, actually dental visits probably are more based on revenue, but if the activity level goes up by 10%, total variable costs would be expected to be also rising by 10% or thereabouts. There should be some direct correlation. Or if the activity level goes down, we should expect total variable costs to also go down. In other words, these are very much product related, I think. And in other words, they're attached to the product themselves. And so I think that what we have to realize here is the fact that some of these costs are directly related to the production activity level. Okay? All right. But one big important concept, and I'll spend as much time as we need to talking about this because it's an area where people get a little bit tripped up, and I say let's go slowly. I think that's the way to go here. And that is this idea of unit variable costs. Unit variable costs. When we talk about unit variable cost, we're simply talking about this. We're talking about the variable cost of production divided by the quantity of production. In this case, the quantity here would be the quantity of an output. And we may use the term, the symbol Q for either the volume of inputs or outputs. But we've got variable costs, which are a dollar figure, and we've got units of output, which are a number figure, which is going to give us a dollar figure, and which we'll simply express as per unit. Okay, and remember, and I've said this a number of times before, but everywhere in accounting and finance, if you have a dollar figure, multiply it or divided by a number, you're going to get a dollar figure. That's the Trump valuation there. Okay, so in other words, we express unit variable costs as some dollar figure, and they happen to be relatively fixed. They might be, say, and it answers the question, what does it cost us to make a pack of cigarettes or a car battery or to deliver a haircut? I mean, whatever the question is. And let's say it's $2.50 per unit, right? And I'm just going to making this number up here. This number is relatively fixed over time because as this goes up, right, this is also going to go up by a sort of proportional amount. And as this goes down, so is this going to go down. So if you've got, and think of these as being sort of forces playing out against each other, if they're going in the same direction, then you're going to have a relatively constant answer, if that makes sense. So when we talk about unit variable costs, we're talking about the cost per unit, just absorbing just the variable costs, okay? And this idea of unit cost is really, really, really important because it answers the question, what does it cost us to make a particular product? In this case, we answered it back in the job order costing. I think we had this idea that it was $39 to make an electronic sensor with the Randall company, which is our example. And that was based upon a job order costing methodology. Again, there's no conflict here, but what we didn't do there was we didn't split up fixed and variable costs, which is what we're going to do here. And there's a reason why we're going to split these up, because sometimes we need to divide these costs and understand what they are so that we can make decisions. Okay. Any questions about that? Because I know this is, and it's going to come up again when we get to the fixed cost portion of this. And if this is not completely understood, that's fine, because I think sometimes as we do some examples, maybe it will kind of sink in. So I don't expect it to be something that's easily apprehensible until we get to it. So unit variable costs are relatively fixed. This sounds like a complete contradiction. Unit variable costs are fixed. And when we get to fixed costs, we're going to say unit fixed costs are variable. So what do we mean here? It means that we're talking about dividing it by the output level. And that's why it's going to vary a little bit. Okay. But in this particular example, I think, and we've got some examples we'll talk about here, at different activity levels, we're going to see a relatively constant amount of variable cost per unit. And so I think the way to explain this then is to look at this next slide in the presentation. And that is an illustration of what total variable costs look like. So I'm going to bring you back to hopefully some math course you've taken in the distant past, we've got some sort of vertical and horizontal axes. We've got an origin right here. And in this case, we've got a dollar amount that's sort of vectoring in this direction. And we've got units that are in numbers, okay? This is an example of the Damon Company manufactures cell phones that contain a $10 camera. Now in this case, we're just tracking one particular component that goes into a final output. It happens to be the camera. It costs them $10 to produce that. As they produce the cell phone, the cost of the cameras increases by $10 every time. So as the graph shows, total cost of cameras will be $20,000 if 2,000 units are produced. So if you look at the intercept here, or the correlation here, 2,000 units will cost $20,000, 4,000, 40,000, 6,000, 60,000. And it's because of the fact that the unit cost, just from a variable cost standpoint, is constant. So if they produce 2,000 cell phones, it's 20,000, 100,000. So, I mean, we've cut up the thousands here, so it's 10,000, and it goes up to $100,000. We've cut off the thousands in both of these, just to make the visual a little bit easier. And so what we got here, and this is an important thing because it's going to sort of tie in, I think, nicely with where this discussion is going with regard to fixed cost and with regard to mixed cost, is we've got a starting point at the origin. If you produce new output, you're going to have zero variable costs, at least those costs which are identifiable with the product itself. And as you produce more, it's going to go up, and it's going to go up in a mostly linear fashion. This is a straight line. And we're going to see here in a minute that this is probably not going to be as nice and pretty and straight line in the long run as it looks like right now. And so that's something that we'll have to deal with, but we'll deal with that when it comes. But what's really interesting about it is we've got a fairly constant slope. Remember, in mathematics, a constant slope implies a constant rate of change between one variable and the other. And so in this case, the slope is the variable cost per unit. And I'm going to elaborate a bit more on that in just a second as we get into some of the examples here, okay? And when we talk about this idea, we're talking about the relevant range. And I'm going to get to that here in just a second because it's a pretty important concept for us to really understand how the behavior of costs work. Remember, this whole issue here, this whole discussion deals with cost behavior. Okay. So we said that unit variable costs were constant, and it happens to be at $10 per unit. So variable cost per unit is constant and fixed, and so we have this constant variable, no matter the level of production. So if we produce 2,000 units, 6,000, 8,000, 10,000 units, whatever, it's still going to cost us $10 per unit to produce every camera that goes into these cell phones, within what we call the relevant range. And the relevant range is this, I think, very aptly named discussion of a bounded area by which we are facing relatively constant costs. So for a $10 camera, every camera is going to cost $10. Now remember, and this is something I want to point to, I'm going to go back here, and I'm going to be doing this a bit here, is referring back to this. In the previous slide, we had what? We had $1 costs for the entire, for everything that's going on. And we had cell phones being produced, okay? But what we were measuring was not the unit cost, was total variable cost. Total variable cost. And notice they are going to change. You produce more output, you have higher cost. You produce less output, you have lower costs, because the cost is captured on this vertical axis here. So what we're measuring here is total variable cost. They probably should have labeled that particular function there as a total variable cost. But here it's not total variable cost, it's total variable cost. And we're measuring these at a cost per unit on this vertical axis with the same horizontal axis here. And so we're saying it's $10 every time we produce a camera. So in that case, unit variable costs are fixed. The variable costs as a whole are not fixed because that's why they're variable. They vary with the level of activity. And remember, that's really what we're trying to understand here, is to understand the activity level. In this case, the activity is producing cell phones. Okay? And this is an important thing to understand, and it's actually good news for businesses because they can pretty well count on the idea of the variable cost per unit as being relatively constant over a particular realm of activity, and which we'll call the relevant range. We're going to talk about that in a second. And in fact, so any questions about variable costs and what those are before I move on here? Because I don't want to go too quickly here. Oops. I don't want to go too quickly here, and I want to make sure that I'm addressing questions as they sort of arise here. I don't see any questions in the chat box. So, okay, variable costs, pretty simple. They vary with the level of activity, and so that's why they are what they are. Let's talk about fixed costs. These may be unrelated to product costs, and as I mentioned earlier, most of the costs we're talking about and have been talking about so far are product costs, but these could include some period costs as well. The key thing is not how we necessarily attach it to the product, it is how the cost behaves itself. And that is, with fixed costs, the term fixed sort of suggests that it's going to be the same, and it's going to remain the same. The key thing here, which is deserved to be underlined, is within a relevant range. And so let's talk about what this idea of a relevant range is, because it's a really important thing for us to discuss. A relevant range is an activity level in which things are relatively constant, things are relatively smooth. And by that, I mean that we're not really changing the mix of inputs very much. We can expand up to a certain point, and we don't have to add new managers, which are fixed costs, right? Salaries are generally an example of that. So we can expand up to that level without having to raise salaries, without having to produce more or have to acquire more equipment, other kinds of fixed assets which create fixed costs, things like machinery and equipment and buildings and whatnot. So the relevant range is this activity of where we tend to operate in the short run, and it's where we are right now usually. And the relevant range is, I think it's fair to say, a short run concept, particularly if we take a view that over time, a particular organization may grow in terms of unit volumes. And as they do that, their input mix is going to change. And so when their mix changes, both variable and fixed costs, then the relevant range has been exceeded and we're into a new relevant range. And this happens all the time. Where companies expand and now they've got a new mix of inputs altogether. It's a different kind of business. It's a different kind of situation. We probably don't talk enough in business schools about this idea that growth sometimes in itself is a problem because we've now got new decisions to make. Just like people who maybe study one of the higher paying professions, engineering, medicine and whatnot, suddenly they find themselves in a new income bracket and they have a new set of problems they have to deal with. And they're problems that are not unpleasant, but they are nonetheless things which have to be dealt with. And the same goes here. When the relevant range is exceeded, things change. And that's both on the upside in terms of growth, moving volume in this direction, and also on the downside as companies are declining in volume. And that, by the way, is not that unusual of a situation, particularly since companies will often deliberately decide to shrink the production of certain business areas because maybe the demand is not there. In the long run, maybe no one's going to want this particular product. It's been superseded by other substitutes. Who knows what? Okay, so if these costs remain the same, then the unit fixed cost varies inversely with the activity. They don't go up directly, but they vary inversely. So, and some of the examples are things like property taxes, insurance. A lot of these don't really apply to product cost itself, at least not direct. They may be very indirect, depreciation on buildings and equipment, and so their behavior is going to sort of be a little bit different in that regard. Okay. Okay, so let's take a look at what an example would look like of fixed costs. And so in this case, what do we got here? Well, this looks like the slide that we go back to with unit variable costs, but it's not. We're measuring something different. We're measuring total fixed costs, and we're saying that regardless of how many cell phones this organization produces, the fixed costs are going to be this amount, $10,000. Okay, it's 10, and we cut off the thousands. So it means that of all these costs which identify themselves as being fixed, that is, they do not vary with the level of activity, then within the relevant range, those costs are going to be in total the same. And they can't vary. Why would they vary? I mean, it doesn't really make any difference. Think about things, and one of the best examples I can think of would be things like the rent on business premises. Whether you're producing a lot within the relevant range or you're producing very little, you're still going to pay the same amount of rent, assuming that the rent is a fixed amount, which is very often the case. Things like equipment leases, we're leasing vehicles, we're leasing computers and furniture and whatnot. It's going to be the same month after month after month. It's not going to change whether we're doing 10,000 units a month or 0 units. It's just not going to change. And so as a result, they have no relationship to the change in volume, which is why we call them fixed. And other things that we're not mentioned here as examples, which I think should be probably mentioned, are things that really we don't oftentimes attach to products. And that's things like insurance, but also things like interest, right? Interest on debt is not necessarily going to change if you're using debt to finance, things like buildings and vehicles or whatnot. And so that's unlikely to change. And salaries are one of those that are oftentimes very much fixed in nature. And remember, we talked a little bit about personnel expense a bit earlier, where we said that, we really have two broad categories of workers in this country as a matter of law, and that is exempt workers and non-exempt. Exempt workers get paid a salary usually, and they don't necessarily have to account for their hours. Non-exempt means they're not exempt from those reporting requirements. They've got to report those. And so those costs tend to be more variable as opposed to salaries, which are more fixed. And personnel expense, again, is very often one of the most significant costs of a business, particularly, as I've said before, in a service context. In a service context, a lot of the costs will tend to be of a personnel nature. Not the only cost, but of a very significant matter, okay? Okay, so remember, we've got this, hopefully everyone can see this, we've got total fixed cost, or it's a flat line, it's going to be the same regardless of level of activity. And it looks a lot like this guy here, but we're not measuring. But unit variable costs, we say, are fixed, just do the math, the proportional issue of the math. And we've got unit variable costs going up like that. What we haven't looked at yet are unit fixed costs, which go down over time. This is a downward sloping thing. And I'm going to spend some time talking about this because it really makes a lot of sense and helps us to really understand the nature of cost itself. It also helps us to, I think, better understand the issue of scale. That is, the idea that as we go up in production, we drop the unit cost, the unit fixed cost per unit, just as simply a mathematical matter. In other words, we're spreading out those fixed costs over more units of production. And to the extent that fixed costs attach themselves to product costs, it means we lower the cost of doing business as we produce more output. And this is really one of the most significant concepts everywhere in finance and economics and accounting. And that's the idea of what economists call economies of scale. And that is, as we produce more output, we drive down the unit fixed cost portion to low levels. And that helps bigger firms, bigger volume firms, oftentimes be more competitive than smaller firms. It also answers the question of why we are an economy of bigger businesses as opposed to smaller businesses. And yes, we know that we've got more small businesses in this country than we do big businesses, but the volume of activity of big businesses completely overwhelm and swamp that of small businesses. And why? And the answer has to do with the issue of scale. And that is, as a big business can produce more at lower cost per unit, even if it's a retailer like Walmart or Home Depot, they can lower their costs, their fixed costs per unit, because they're spreading it out over so much higher level of output. And this is why we see a lot of big businesses, and why we have seen over a very long time period the death of small businesses particularly in certain areas. There are very few family-owned drugstores, grocery stores, auto repair places. They're all dominated by big players, mostly based upon this issue of scale. And I'm not saying that none of these small organizations exist, but they used to be much, much, much more prolific in our economy than what they are now. And so this is the idea of what's going on here. And so just kind of go to the slide, and I'm going to sort of bring in a little bit of my own input here. In this case, we've got $10,000 per month are the fixed costs. And we're going to assume that those are the only fixed costs that we've got here. And so as a result of this, as we produce more output level, the formula here looks like this. It's fixed costs over the quantity of output. And so think about this. Whereas here, let's just take the matter of, let's just take rising costs here. If the output level goes up, the variable costs go up when it comes to variable costs. But when it comes to output levels, if the cost of production rises, the fixed costs do not change at all. And so as a result, as this goes up and up and up, it's just the mathematics of how this works. The denominator rises and the numerator stays the same, meaning that you're going to have a smaller and smaller and smaller fraction the greater this thing goes up. And I'm sorry, the quotient is going to be smaller. And it's going to be some dollar figure per unit. And it's going to be fixed cost per unit. And it's not going to be fixed at all on a per unit basis. It's going to go down as output level increases. So does everybody see what the math is that's happening here? Output goes up and up and up and up, and fixed costs don't do anything at all. So to the extent that we've got fixed and variable costs both contributing to product cost, fixed cost goes down. And so as a result, the firm benefits simply based upon the level of scale. And just to kind of give you a bit of an example here, I just kind of want to kind of show you how this might work. I know we have an example of the Damon Company in the text, and just to kind of give you an idea here about how this might work and sort of illustrate, I want to keep the math even more simple here, where I want to take, remember we have an origin here, we have an output level here, we're going to call that quantity of an output. And I specify output as a sort of a subscript here because we may have occasions to redefine the quantity as being quantity of an input, but we're not quite there yet, okay? And then we want to talk about dollar costs here, okay? All right, so what do we got going on here? We've got output levels. Let's just say we have output levels of 100 units and 1,000 units and 10,000 units, okay? I'm just going to pick 3 different points of output on the horizontal axis here. Remember, these axes go on forever. Theoretically, there's an origin here and whatnot. And so let's say in this example we've got, and we're going to say this is within the relevant range. And I'll talk much more about the relevant range, probably more on Wednesday. The relevant range is this point by which we do not have to add new facilities, new input combinations, new managers and whatnot. So in this case, I'm going to say the fixed costs are 100,000 for whatever it is that we're doing, okay? All right, so we want to determine the fixed cost per unit, and we want to do it at various levels here. And so let's do that. Let's take fixed cost per unit, and we'll take fixed costs of 100,000. Remember, those costs are not changing, and we're going to divide it by 100 units. Okay. So fixed costs divided by this, and we're going to end up with what? It's going to be $1,000 per unit. Is that right? Yeah, it's going to be $1,000. And so as a result, 100 units, we're going to say it's $1,000 fixed cost per unit, based upon 100 units of output. Okay? All right, so that's the first of these particular output levels here. And so let's go on to the next. We've got 100,000. And we want to divide it by, you know what, this is yeah, no, that's right. And we want to divide it now by 1,000. And this is going to be 100. So as a result, we're just going to apply, and I don't know if this is particularly drawn to scale. We're going to plot 100 there. Okay, 1,000 units of output, $100,000 of cost, and gives us $100 of fixed cost per unit. Okay, And then the final one is we have 100,000 of cost, but on the third level of activity, which is 10,000, which is going to give us $10 per unit. So we're going to plot that right there. Okay. And all I'm really trying to do here is just to try to show you the nature of this particular relationship. Fixed cost per unit is going to decline over time. It's going to be a fairly curvy kind of thing here. But the key thing is it's going to be downward sloping. And the idea behind this is that there's an inverse relationship between output level and fixed cost per unit. And so fixed cost per unit is going to be downward sloping. And again, this idea shows us that as we produce more output, we drive this, at least this portion down, down, down. And again, it goes to this idea that firms, that bigger tends to be better. And I know that that's not something that everyone likes to hear, but it does explain why big businesses tend to succeed more than smaller businesses. Is the idea they can just simply drive down their unit costs, at least the fixed cost portion of it, to levels that are much lower than smaller businesses. And by the way, not only can they do it with fixed costs, they can often do it with variable costs, because they can often sometimes make such big orders that they can negotiate better prices on the units of inventory, and even of things like materials and insurance and all kinds of things. Insurance is considered more a fixed cost, but things like materials and inventory and supplies and whatnot, they can drive those costs down, 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 simply by virtue of their size. So size matters. It does drive down the cost of production, and it's an important concept, this idea of economies of scale. Okay? So any questions about how I got to that? This is just one very simple example here that I brought up, because I think it's important for us to kind of be aware that these costs, the cost behavior is really an important analysis. And I know that if you haven't taken microeconomics yet, this may be new. And the good news is that for a business school student, that you'll have microeconomics presumably at some time, and you will at least be exposed to some of these concepts, and that's good. If you're not a business school student, well, then there's no harm and no foul, because these are concepts that are very important in what we're doing here. Okay? All right, so any questions about what we've done there in terms of just another example here? I thought it would be an easier example to look at, and it would be one that it might be helpful if we plotted points on a graph to kind of show what these relationships are of a downward sloping function. So unit fixed costs have that particular behavior. Okay. All right. Let's talk about, so let's kind of wrap this up a little bit here. This particular segment, we'll sort of move on to the next here, which we're going to get into some other topics. And so variable costs, so one of the quick review questions, variable costs are those costs which do what? Vary in total, directly proportionally with changes in the activity level, or remain the same per unit every activity level. So the answer would be correct. It would be both A and B. They do both of those. Okay. In total, they are variable, but per unit, they are fixed. And that is something that seems like a contradiction, but not really once you start to apply the mathematics of the situation. Okay. So that, I think, is the important thing for us to realize as we understand this. Okay. All right. Questions? Okay, let's talk about this idea of relevant range. I've sort of been talking about it, and I didn't give as in-depth discussion about what it is, but what is the relevant range? We're talking about what is possible, at least in the short run, and that as a result of this, we're going to have a relative case of stability as to variable cost and fixed cost both. Knowing that in the long run, which is sort of undefined, frankly, all costs are going to be variable. This is something that comes out of microeconomics, where we say that in the long run, everything is moving around and changing. We can't really hang our hat on fixed costs. But in the short run, we can. In the short run, we can. And in fact, we kind of have to, in the short run, understand that there are going to be some costs which are going to be fixed in total as we produce more and more units of activity. But we're going to sort of get to the point where we're going to sort of change these kinds of relationships. These are not always going to be quite as stable as what we might like to see. Just as an example here, and I want to kind of back out a little bit. What we're doing here is, I know we've, this is not the best setup, I think, for showing what we're doing here, but if you take a look at something like this. So this is a short run model of a company that can produce anywhere from 0 to 10,000 units of output, or whatever it is, doesn't really make any difference. Okay? And when I say short run, and I sort of put that next to the term long run, I know people always want to ask, well, where does the short run stop and where does the long run begin? And I can't really give you a good answer. And that is because of the fact that it really happens when the input mix changes. And remember, inputs create costs. And so if inputs are changing because the nature of the business is changing, they're growing so much, et cetera, then it's we've moved on to a new relevant range. Well, let me just give you an idea of what we're looking at here. And I don't have a time series on this. I'm just going to say we've got the quantity of output on this horizontal axis here. So it's the same that we've seen over here. And we've got the same dollar figures up here on this vertical axis. But here's the nature. This is not fixed cost per unit. This is just fixed cost. Where we're producing somewhere between 0 and, I don't know, whatever, we'll call it point A. Now we've got fixed costs that look like that. And we'll call that fixed cost level 1. But as we get to that level, we've decided that, okay, we now need more supervisors, we need more facilities, we need to lease another building, we've got to rent a couple more trucks, we've got to step it up. And so what tends to happen is we have this jump or step upward. And so as a result, we have something that we call a step function, where now we get to some new level and and so now we've gone to a new level of cost. And so fixed cost 1 is here, fixed cost 2 is here. So going between point A and point B means we have to step it up because we have to hire more supervisors, more plant managers, we have to rent new facilities, we have to, step up all these kinds of investments. And so we have a step function. And as we continue to grow, we continue to have this kind of thing going on here. Well, now we go to fixed cost 3 as we go between that and point C on the production level. This is what we call a step function. And this is the idea that these are chunky and whatnot. And remember, let's go back to one important concept, and that is, and it's something I talked about some time ago, and that's the idea that inputs create costs. And so therefore, fixed inputs create fixed costs. Okay. And yet, in the short run, they're fixed. Okay. But what do we just say about costs in the long run? We said in the long run, all costs are variable. That over time, the inputs are what we call lumpy inputs. And I didn't just make that term up. They're lumpy. It means that we can't, if we grow, we can't rent 1/32 of a factory. We can't hire 1/20 of a manager. We have to go all the way, or we don't go anything. We don't go at all, right? We either go all the way, or we don't. We jump or step upward, or we don't. And we keep on the same input level, the same trajectory with regard to cost, which may not be a good idea because, again, I think the idea of managing costs to always minimize them is sort of short-sighted in very many ways. And I say it not just as a personal preference, but rather I think the evidence is overwhelming that sometimes companies need to recognize as we're growing, we have to hire more people, maybe more salaried staff, maybe more support staff like IT personnel, HR, accounting, marketing, all these kinds of areas. And these tend to be more of a fixed variety because these tend to be more salaried personnel. Also, things like facilities and buildings and whatnot. And so these inputs are what we call lumpy. And we don't just buy a tenth of an office building, we buy a whole building, right? So as a result of it, they take a jump or a step over time. And I think that's really an important characteristic of the nature of fixed costs. Because remember, what we're getting into in this particular segment of classes is the behavior of costs. How do costs behave and why? And they're very much related to the nature of inputs. So fixed inputs, salaries, the inputs would be people, and the salaries that flow from them, they create fixed costs. And so as a result, over time, they're lumpy, they're chunky. You can't add a fractional person or whatnot. You have to go all the way. And so as a result, they're lumpy. And we have this sort of fixed nature over time. Which tells us then what? What's the big takeaway here? If fixed costs are not really fixed, because they're fixed here at one level, they're fixed here at one level, they're fixed here at another level, in the long run, all costs are variable. And that's an important thing for us to realize. And it takes us back to this important level of the relevant range. So does anyone have any questions about what I've done here? Hopefully I haven't gotten too, hopefully these graphs are easy to see. Sometimes I know the sound quality is not great. I'm sure I know that. I've looked at some of these videos and the sound is not good, but hopefully everyone is sort of understanding what I'm talking about here. And if you don't, feel free to get with me. So in this case, the relevant range, again, is the activity level where things are relatively stable, but understanding in the long run, and the long run is some point that exceeds the relevant range, usually to the growth side, but it could also be on the downside as well. And that we don't have these fixed linear relationships. In fact, they tend to be more curvilinear, which is the same as saying that they're non-linear. Remember, a linear function is simply defined as the idea that between any 2 points on that function, on the graph of that function, the slope is the same. It's the definition of a linear function. But over time, though, we're saying that these are not fixed. And again, things may be changed, or things like new product development, management training, and these are some examples that your text has that might explain why fixed costs may blow through the relevant range at some point. So as an example here, and I like this. This is you can look at a microeconomics textbook and come right back to that. So variable costs, which we thought were sort of linear, are not really that at all. They sort of rise. They're sort of constant for a time. Then they take a step upward, mostly because it's probably because the company needs to invest in more input in more fixed inputs in order to make their lives more efficient. Remember, machinery tends to make us all more efficient. This is why we use machinery and equipment and whatnot. So the slope of this guy kind of changes. The non-fixed costs, which I'm sorry, the total fixed costs, are also taking a step function upward. So none of these over some scale between 0 and 100. Again, the percentages are sort of arbitrary here, but none of those represent one straight line at all. But yet we can say, okay, that within the relevant range, the variables are constant. So within the relevant range of activity, between 60 and 80% of maybe capacity, we might say, we got a relatively straight line here. So in other words, variable costs are rising at a proportional rate to production, which means that the slope of this function is the variable cost per unit, and that's constant within the relevant range, which is the shaded area here. And it tells us that we're in a range in which we don't have to add more inputs, usually of a fixed input variety. And so as a result, things are relatively stable. And I think for most organizations, they find themselves operating sort of within the relevant range. If you're a company that makes refrigerators, and you make 300,000 refrigerators this year, are you really going to be talking about doing 30 million refrigerators next year? Probably not. I mean, you're probably not that far out of the scale. Unless something has happened, we've acquired another company and whatnot, in which case everything has to be reset anyway. Within the relevant range of activity, usually companies grow within a constant rate. Now, some grow faster than others, and when they do grow faster than others, they've got to change their input mixes to reflect that. But notice this, within the relevant range, in both these graphs are the same areas of the horizontal axis here. And notice that variable costs are relatively stable and rising because variable costs rise proportionally with the level of output. And fixed costs are truly fixed in that very short run period. In the longer run, which encompasses a greater activity level, these costs can rise and usually tend to be mostly fixed as we change our level of production. So that's what relevant range is all about. It's this idea of of where we kind of live. And I think that one of the problems that we get into sometimes in management is this idea that management wants to sort of push outside of the relevant range and do the kind of things to grow quickly as a competitive matter to serve a growing market. And there's not enough attention sometimes paid to what the ramifications are on the cost front and how that is to be dealt with. And if the managers who want to keep pushing beyond the boundaries of whatever the current relevant range is, which is not quite as shaded and nice, but it's sort of an area that is there, but it's not maybe as perfectly delineated here. But if they're trying to push it and they don't, and they also are very conservative and stingy on costs, they're going to find their goals to be thwarted simply because inputs create costs. And if you want to produce outputs, you got to have inputs. You have to pay for inputs, and so that's an important aspect of this. Okay. We only got a few more minutes left, and I know I've been keeping the class a little bit longer than what I need to, so I just want to do a couple more things and before we move on. I think that a good stopping point is at the beginning of the mixed cost discussion. So the relevant range is what? So it's the range of activity over which variable costs be curvilinear, it's the range in which fixed costs will be curvilinear, or it's the range of which the company expects to operate. And it's usually from 0 to 100%. Well, it's not from 0 to 100% of operating capacity. And by the way, we really haven't talked about operating capacity. Operating capacity basically says, okay, 100% is the absolute limit that this factory can produce, or this business can produce. 0 is 0, obviously. Well, this is not saying something is between 0 and 100% isn't saying anything at all, really. So the answer to this is C. It's the range over which the company expects to operate during the year. And what's interesting about this particular slide is the horizontal axis is between 0 and 100% of capacity or activity level 0 to 100%. I know that not every company does one output. This can be very much separated by different business units, different products, even different geographies. Okay. All right, one final thing, because I don't think I'm going to have too much time to get into this, and I certainly won't be able to do it justice, is we've talked about variable costs, those costs which change and go up and down proportionally with changes in the output level, outputs of whatever it is, toasters, hairbrushes, haircuts, razor blades, car batteries, whatever. And we talk about fixed costs, which are all those other things which tend to be not associated with volume levels. Things like interest cost and building leases and whatnot. What about costs which have elements of both that we call mixed costs? This is really an interesting set of costs here, because an example given, I think, is a really good one, is renting a U-Haul. And I think for all of us who've rented a U-Haul before, or I think even sometimes car rentals, is you've got some fixed amount you're going to pay plus an activity level you're going to pay based on maybe mileage. So there's going to be a fixed amount everyone pays, regardless of however many days. It's usually based on some days or miles or whatever. But there's going to be a fixed amount. But then most of the cost, the shaded area is going to be of a variable cost based upon how much the product itself is used. And that's sort of a retail example. We're going to be sort of flipping this around a little bit to talk about the supply side, because we're going to talk about cases in which firms experience mixed costs. And one of the big ones here, in my mind, are utility costs, which a lot of companies are billed with a utility cost that's fixed based upon just the privilege of having the product being brought in, piped into the business, and then everything else is volume based, which is the bulk of the cost based upon how much electricity is used. And that's just one of many examples, but that's an example of mixed costs. The problem that mixed costs have, though, is the idea that they bring in fixed and variable costs both. And sometimes we have to do a little bit of work. And there are a couple of different methods we use by which we break out the fixed from the variable costs. Okay. And so when we come back on Wednesday, this is a good picking up point, because I don't think we're going to have a chance to get into this, but we'll talk more about this idea of mixed costs. And then we'll talk about at least one method by which we sort of pull apart the components of these, which are both fixed and variable. Okay. All right, so any questions for me about anything that we've talked about today so far? Okay, well, feel free to get with me if you have any questions about anything at all. Again, we've deferred I've deferred the due date for the homework quiz and bonus on this till next week. So this gives you more time to read and absorb some of the content. Obviously, you're free to work the problems and exercises now if you like, but the due date's not until next week. So when we come back on Wednesday, I want to pick up right from here, talking about mixed cost and what to do about it. Okay. I don't think we have any questions, so if there are no questions, I think that'll do it for today, and I'll see you all on Wednesday.